Okay, let's unpack this whole idea, making money while you sleep, passive income. I mean, for a lot of people, it sounds almost like a fantasy,
Yeah,
right?
well,
Yeah.
or something only for folks who are already, super wealthy.
Exactly. But the sources we've been digging into, they really push back on that idea. They frame passive income not just as some far-off dream, but as a genuinely viable strategy, something achievable for transforming your finances.
Absolutely. And what's great about this material is it's not just theory, it maps out a real journey. So this deep dive is really for you, pulling out the most actionable stuff, the key insights to help
Yeah.
guide you from wherever you are now
Hmm.
towards actually using passive income streams for real financial growth and eventually freedom.
Right. Our mission here is to kind of cut through the jargon and the noise. We're pulling out those essential bits, the practical steps, the strategies that maybe surprise you, those aha moments
Yeah.
that help you really get how to build and grow it, making your money start working for you. Seriously.
And the sources take us through it logically. We start with the basics, like what is investing, then move into a step-by-step process to actually do something.
Right.
Then we zoom in on powerful streams like dividend stocks, real estate, talk about scaling up, which is critical.
Mm.
And finally, what does it actually feel like? What are the real benefits of that financial freedom? It's structured, but full of really dynamic ideas.
So think of this as your shortcut, maybe. We've boiled down what the sources say into the core insights you need to navigate what can feel like a pretty daunting world finance and start unlocking that passive income potential.
Okay, so let's just jump right in. First things first. What exactly is passive income, according to these sources, and why does it matter so much?
Well, the sources are pretty clear on the definition. Passive income is basically money you earn from things like, say, a rental property you own, or investments like stocks, maybe even some business interests where you aren't actively trading your day-to-day time for that specific income.
Right, it's the opposite of your 9-to-5 job. It's about building up assets, things that generate income for you, without needing your constant hands-on effort.
Mm-hmm. And the sources highlight a few main ways people do this successfully. Dividend stocks are a big one, companies sharing profits. Real estate investments, too, whether that's actually owning rental properties or maybe investing indirectly, like through REITs.
REITs, yeah, real estate investment trusts. Good option for diversification without being a landlord.
Exactly. And they also mention peer-to-peer lending, basically lending money out and earning interest on it.
The appeal is pretty obvious, isn't it? Getting paid while you're, I don't know, sleeping or traveling or doing something you actually love. That freedom with your time is a huge pull.
Massive. But, and this is key, the sources really stress that passive income isn't achieved passively. You don't just stumble into it, it takes strategic thinking.
Definitely. Why? Because having a strategy gives you direction. Just saying, I want passive income, well, that's too vague. The sources push you to get specific. Like, set a real goal. My first target is, say, $500 a month coming in passively within the next 18 months. Something concrete.
Yeah, that focus makes a difference. And the strategy part helps manage risk too, right? Instead of just like randomly buying some stock you heard about.
Right, no chasing tips.
The material guides you to analyze things first. Look at dividend history. Understand the market trends before you put your money in. It helps you make informed choices, not just react.
Exactly. Better decision making. It's grounded in research, not just gut feelings or hype. And the sources illustrate this really well, showing how different strategies fit different goals. Like if your main aim is building wealth long term,
Yeah.
maybe dividend growth stocks are your focus,
Okay.
need income sooner, maybe rental properties make more sense, saving for retirement. That
Yeah.
often means structured contributions to things like 401ks or IRAs, which are then invested.
Right, employer matches and things.
Yeah. And if you want multiple streams, maybe adding something like peer-to-peer lending could fit. It all links back.
It really does make sense. Defining what you want shapes how you get there. It's an active effort to achieve that passive result.
Precisely. And that effort starts with, well, getting the basics down pat,
Yeah.
understanding the fundamentals.
Which leads us straight into setting that foundation,
Hmm?
understanding investments and actually building your portfolio. The sources break down investing really simply. It's just putting money into something expecting a return later, either through income, like rent or dividends or appreciation. The thing itself becomes worth more.
And they walk through the common types,
Hmm.
sort of giving you the landscape. You got stock shares in companies, potential for high returns, but also, more volatile.
Mhm. Ups and downs.
Then bonds, basically lending money to governments or companies for fixed interest, generally seen as safer, less risky than stocks.
Okay.
Mutual funds. where lots of people pool their money, and a manager invests it in a diversified mix of things. Index funds are a type of mutual fund. They just track a market index like the S&P 500, often lower fees, great starting point.
Yeah, I hear about those a lot.
Then real estate, physical properties, rentals, flipping. In cryptocurrencies, digital money. The sources flag these as potentially high reward, but also high risk. Handle with care.
The big takeaway here, and the sources really hammer this, is that knowledge is crucial. You need to understand how each of these works, what the risks are, so you can build a strategy that fits your goals, how much risk you're okay with. They suggest maybe starting with a mix, like balancing stocks and
And to
bonds.
find that balance,
Yeah.
and once you kind of grasp the tools, you start building your portfolio. The sources call it your financial fingerprint. It's unique to you.
I like that financial fingerprint.
It's shaped by your risk tolerance. How comfortable are you with potential losses? They even suggest taking a quiz to figure that out. Also, your goals, short-term versus long-term. Saving for a house in 5 years is different from retirement in 30.
Very different.
And crucially, diversification. We keep saying it, but it's vital.
Don't put all your eggs in one basket, the classic advice.
Exactly. And the sources give concrete examples, not just saying diversify, but showing how. Maybe a portfolio could look like 50% stocks, perhaps spread across different sectors like tech and healthcare, 25% bonds, maybe government and corporate, 15% real estate, perhaps through those REITs for simplicity, and maybe keep 10% in cash or equivalents like a high-yield savings account for safety or opportunities.
That breakdown helps visualize it.
And this isn't a one-time thing.
Mm.
You need to keep learning, keep reading, and adjust your portfolio periodically. Use investment tools. There are tons of apps now for tracking, calculating returns, rebalancing.
Right, setting alerts, things like that.
All essential. It helps manage the process.
It's definitely presented as a long game, a marathon, not a sprint. Patience and consistency are key for building that solid foundation.
Okay, so foundation's built. Now what? The sources then lay out a really clear step-by-step transformation process. This is where you turn that knowledge into action.
Right, this is where the rubber meets the road, as they say. Step 1, setting investment goals. But really digging in, not just get rich, but defining specific short-term things like, I want to save $10,000 for a down payment in 3 years. And long-term, like retire comfortably by 60.
And they push hard on using that SMART framework. Making goals specific like that $10,000 number. Measurable, how will you track progress? Maybe monthly savings targets. Achievable, is it realistic? Relevant, does it actually matter to you? And time-bound, setting that deadline like by June 2026. It turns a wish into an actual plan.
Makes sense. Step 2 is researching investment opportunities. This means finding areas that actually interest you. Maybe you like tech, so you look into tech stocks. Or maybe you know your local area well, so real estate there makes sense.
Yeah, follow your interests sometimes. And critically, use good sources, reputable ones. The sources mention examples like The Motley Fool for stocks or Bigger Pockets for real estate, places known for solid research, not just random tips.
Right, and they suggest using a kind of SWOT analysis, strengths, weaknesses, opportunities, threats, applying that to an investment. For a stock, what's its market position? That's a strength. Are there new regulations coming? Weakness, can it expand into new markets? Opportunity, are new competitors emerging? Threat, it forces structured thinking.
It helps avoid blind spots.
Take
Okay,
care.
step 3, making initial investments. This can feel like the biggest hurdle.
Totally. Scary step.
The sources are smart. Here they say start small, really small if you need to, maybe buy fractional shares first, just a piece of a stock. It lowers the risk while you learn the process, get comfortable making transactions.
Get the hang of it without betting the farm.
Exactly. And diversify early on, even with small amounts. Maybe start with that simple split we talked about. Say 50% in a broad stock index fund, 30% in a REIT, 20% in a bond fund. Something balanced. And using discount brokerages is key. Low fees matter a lot over time.
Good point. Okay, finally, step 4. Monitoring and adjusting strategies. It's not set it and forget it.
Not at all. The sources emphasize regular reviews. Maybe check in monthly using those tracking apps. Stay informed, read financial news, newsletters, keep learning.
And be prepared to adjust based on how things are performing. If one investment consistently lags and you understand why, don't be afraid to pivot. Maybe sell that underperforming stock and put the money into an index fund instead. It's about active management.
Yeah, success isn't just luck. According to this material, it's about engaging with your investments, understanding what's happening, and making disciplined changes based on your strategy, not just reacting emotionally.
Okay, so once you're up and running, executing those steps, the sources really zoom in on leveraging specific passive income streams. They highlight two big ones, dividend stocks and real estate.
Yeah, exploring dividend stocks is presented as a real cornerstone. The idea is simple. You buy shares in profitable companies, and they send you a portion of their profits, usually every quarter. You can take the cash, or, and this is powerful, reinvest it.
Choosing the right companies seems crucial here. The sources say focus on established players, sometimes called dividend aristocrats or dividend kings companies, with long histories of paying and, importantly, increasing their dividends consistently.
Right, that track record matters. Use stock screeners to find them. Think household names often, like Coca-Cola or Procter& Gamble, companies with proven staying power and dividend policies.
And they really push a dividend growth strategy focusing specifically on companies likely to keep increasing those payouts. That's where dividend reinvestment plans, or DRIPs, come in. They sound amazing.
They are. Instead of cash hitting your account, the dividend automatically buys more shares of that same company, sometimes even fractional shares.
So it compounds automatically.
Exactly. Creates this fantastic snowball effect.
Yeah.
Your shares earn dividends, those dividends buy more shares, those new shares also earn dividends. It just builds on itself.
Yeah.
A positive feedback loop.
Wow. And keeping track helps visualize that growth, right? Like using a spreadsheet. The sources show examples. An initial investment might grow okay just from the stock price going up, but add in those reinvested dividends, and the total value climbs much faster because you own more and more shares over time.
Yeah, the difference can be really significant over 5, 10, 20 years. Okay, the other big one is investing in real estate. Buying physical property, usually to earn rental income or sell later for a profit. The sources often focus initially on the buy and hold rental strategy.
But again, research first. Crucial. Not just finding any house, but researching locations. The sources say look for areas with good job growth, good schools, amenities people want. Using platforms like Zillow or Redfin for data, not just listings. Understand the market trends.
Absolutely. And leveraging financing. Using a mortgage, often needing 20% down for investment properties, lets you control a bigger asset without using all your cash. That leverage is key for scaling up later.
And then there's property management. The sources talk about hiring a company to deal with tenants, repairs, collecting rent. That's the passive part for you.
Right. Frees up your time.
Hmm.
But you have to factor in their fees, of course. It's a trade-off. And they also mention alternatives again, like those REITs, if you want real estate exposure without the landlord duties.
So combining these two dividend stocks and real estate seems like a powerful way to diversify, according to the sources. Spreads your risk.
Definitely minimizes reliance on just one thing going well.
Okay, so you've got the foundation, you're taking steps, leveraging streams like stocks and real estate. What's the next gear? Scaling up for that serious long-term success? This seems to be about building real momentum.
Yes, absolutely. And the sources are really emphatic here. Reinvesting profits. It sounds simple, but it's maybe the most powerful lever early on. Don't spend the income your assets generate, at least not all of it initially. Pump a big chunk back into buying more income-producing assets.
That's where the magic of compounding returns really kicks in, isn't it?
That's exactly it. Reinvested dividends buy more shares that pay dividends. Rental income can go towards the down payment on another property or paying down the mortgage faster, which boosts your cash flow or equity. It just accelerates everything. That snowball rolling downhill.
The sources use tables to show this, right? How a portfolio might grow much faster year over year when profits are plowed back in compared to just taking the income out.
Yeah, the difference is stark over time. It really amplifies growth, and reinvesting also builds flexibility. As those earnings grow, you have options. Maybe reinvest in the same things or use it for a different type of investment or fund renovations to increase rental income further.
Having a plan for it seems key, though. The sources suggest maybe committing to reinvest, say, 50% or even 75% of all passive income automatically, at least for the first several years, builds discipline.
For sure. The other pillar of scaling up is diversifying income streams. This isn't just a nice to have. The sources frame it as fundamental for protecting your financial future. Relying on just one or two things is risky. Markets shift.
So branching out.
Exactly.
Yeah.
Expanding beyond just stocks and rentals. Maybe looking into peer-to-peer lending platforms we mentioned, or even creating something small online, like an ebook or a course, something you build once that can generate sales more passively later.
Interesting. Or diversifying across different types of assets altogether.
Right. The sources mention considering things like commodities, maybe more bonds for stability, or even, cautiously, a small allocation to crypto, depending on your risk appetite and where you are in your journey. It builds resilience. If the stock market dips, maybe real estate or bonds hold up better, or vice versa.
They also mention leveraging platforms, like sharing expertise.
Yeah, like starting a niche blog or doing webinars or creating courses on platforms like Udemy or Teachable. If you've gained expertise, packaging it can become another income stream. And if real estate is your thing, scaling means adding multiple properties over time. Each one is a new stream, stabilizing your overall revenue.
The sources use tables here too, showing how having income from dividends, PLUS rent, PLUS, maybe some P2P lending interest, all grow over time. If one has a down year, the others can cushion the blow. It builds a much stronger foundation,
It's all about building those layers, making your financial base wider and more resilient.
which ultimately leads to the big goal for many, achieving financial freedom. The sources define this really nicely. It's not just a dollar amount, but having enough passive income rolling in to cover your living costs, giving you the choice and the freedom to live how you want.
And the benefits they describe are very real. First, obviously, time freedom. Being able to spend quality time with family, pursue hobbies, travel without worrying about vacation days. The sources give this great example of someone taking a month-long trip to Europe, totally funded by passive income.
That sounds amazing. And less stress too, right?
Huge. Reduced financial stress. Knowing you have multiple income streams not tied directly to your daily job just lifts a massive weight. Less anxiety about bills, job security, unexpected costs.
It also seems to create opportunities.
Definitely. Opportunity for growth and exploration. That passive income base gives you the confidence and the capital to maybe start your own business, invest in something new, or even shift careers into something you're passionate about, like mentoring others is one example mentioned.
It's a safety net as well. That cash flow provides security for emergencies or allows you to take calculated risks on new projects. And for many, it's about legacy building, creating opportunities for kids, supporting causes, making an impact.
Yeah, and the sources really illustrate this snowball effect with clear examples, showing how total passive income might grow from, say, $20,000 a year to $40,000, then $70,000 over just a few years, through consistent strategy and reinvestment, eventually reaching that point where it covers expenses.
But achieving freedom isn't the end point, is it? The journey continues. You have to plan to keep it and grow it.
Exactly. Planning for future growth is crucial. The sources lay out concrete steps for this phase too.
Like setting new, bigger, long-term goals, keeping your eyes on the next prize, maybe aiming for a certain portfolio value by a specific age, and mapping out how to get there.
And never stop learning. Continuously educate yourself. The financial world changes constantly. Dedicate time each week, maybe just an hour or two to reading, listening to experts, taking courses. Stay current.
Embracing technology, too. Using modern tools for tracking, analysis, even automating reinvestment or savings transfers, efficiency matters.
Networking becomes important too. Connecting with other investors, mentors, joining forums or clubs. It brings new ideas, perspectives, potential deals, and just support.
And finally, that regular review and adjustment. The sources suggest meticulous quarterly reviews. Does your strategy still align with your goals? Are adjustments needed? Reassessing investments logically, not emotionally.
So achieving financial freedom, based on this material, isn't just reaching a destination and stopping. It's a dynamic state with incredible benefits choice, opportunities, peace of mind, but it's sustained by ongoing informed planning and action.
Wow. So looking back at this whole path the sources lay out, it really is a transformation. You start with just getting that basic understanding, getting clear on your goals, using SMART goals.
Then you move into action, doing the research, making those first investments, even if they're small, and making sure they're diversified.
Implementing those really powerful growth engines, reinvesting profits consistently, and deliberately building multiple varied income streams.
Which leads to that incredibly rewarding stage,
Yeah.
achieving financial freedom, experiencing the time flexibility, the lower stress, the new opportunities that open up.
And then, crucially, committing to that ongoing planning for the future. Ensuring the freedom you've worked for is sustained and keeps growing through learning, using smart tools, connecting with others. It's a journey from just being interested to being a genuinely empowered strategic investor.
Yeah, it really is.
So for you listening, maybe feeling like this sounds like a huge mountain to climb, let these insights be genuinely encouraging.
Definitely. First takeaway, start small, think big, don't get overwhelmed, focus on the next small, achievable step, but always keep that bigger vision of financial freedom in mind.
And remember, learning is lifelong here. Your curiosity and willingness to learn and adapt, that's probably your single biggest asset.
Absolutely. Stay patient and persistent. This stuff takes time. Compounding and diversification work wonders. but they need consistency. Stick with it.
Find your people. Embrace a support network, online forums, local clubs, investor groups. Connecting with others keeps you motivated. You share knowledge, hold each other accountable.
Yeah, that community aspect is important. And visualize your success. Seriously. Make a vision board. Write down your goals where you can see them. Making it tangible really helps solidify your mindset and drive your actions.
Ultimately, as the sources really drive home, investing isn't just about spreadsheets and stock tickers. It's about fundamentally changing your life, creating options and opportunities. And the most powerful tool you have, it's your mindset.
Couldn't agree more. That's foundational.
So building on that idea mindset and always learning, here's something for you to think about after we wrap up. What is the very first concrete step you'll take today? Could be tiny, could be bigger. But what step will you take to start shifting your financial mindset and begin writing your own story of passive income and financial freedom?